This presentation is for Accounting 221, Accounting Principles 1, Chapter 9, Plant Assets, Natural Resources, and Intangibles. The first three learning objectives are to measure the cost of property, plant, and equipment, to account for depreciation using the straight line, units of production, and double declining methods, and to journalize entries for the disposal of plant assets. The last four learning objectives are to account for natural resources and intangible assets, to use the asset turnover ratio to evaluate business performance, and to journalize entries for the exchange of plant assets. In the first section, we will learn how to measure the cost of property, plant, and equipment. Plant assets are long-lived tangible assets used in the operation of the business. These assets include land, buildings, equipment, furniture, fixtures, and automobiles. Often, property, plant, and equipment are referred to as plant assets, operational assets, or fixed assets in financial statements. Plant assets are different from other assets such as office supplies because plant assets are long-term, lasting several years. This requires a business to allocate the cost of the asset over the years that the asset is expected to be used. This allocation of a plant asset's cost over its useful life is called depreciation and follows the matching principle. Depreciation is the process by which businesses spread the allocation of a plant asset's cost over its useful life. The matching principle ensures that all expenses are matched against the revenues of the period. Because plant assets are used over several years, a business would record a portion of the cost of the asset as an expense in each of those years. All plant assets except land are depreciated. We record no depreciation for land because it does not have a definitive or clearly estimable life, so it is difficult to allocate the cost of land. Exhibit 9.1 summarizes the life cycle of a plant asset in a business. The business begins by acquiring the asset and recording the asset on its books. This involves determining the asset cost that is reported on the balance sheet. As the business uses the asset, it must record depreciation expense. In addition, the business also incurs additional expenses such as repairs and maintenance related to the asset. Finally, when the asset has reached the end of its useful life, the business disposes of the asset. Each of these stages in the life of a plant asset must be recorded on the business's books. Plant assets are recorded at historical cost, or the amount paid for the asset. This follows the cost principle, which states that acquired assets and services should be recorded at their actual cost. The actual cost of a plant asset is its purchase price plus taxes, purchase commissions, and all other amounts paid to ready the asset for its intended use. The cost of land includes the purchase price, brokerage commissions, survey and legal fees, delinquent property taxes, title transfer fees, the cost of clearing the land, and the cost of removing old buildings from the land. Land is a unique kind of plant asset that is never depreciated. The cost of land does not include fencing, paving, sprinkler systems, lighting, signs, and other improvements to the land, such as landscaping. These costs are collectively referred to as land improvements. A land improvement is a depreciable improvement to land. These costs are separately identified from the land itself, and they are depreciated. Assume that Smart Touch Learning buys land on August 1st for $50,000 and pays for it with the note payable. Other costs related to this transaction include $4,000 in delinquent property taxes, $2,000 in property transfer taxes or fees, $5,000 to remove an old building from the site, and $1,000 for a survey of the property. All other items are paid for with cash. What is the cost of the land on Smart Touch Learning's books? As you can see from the computation in Exhibit 9.2, the cost of the land is not only the acquisition cost of $50,000, it also includes an additional $12,000 of costs that bring the total cost of the land on the books to $62,000. The journal entry to record the acquisition of the land would include a debit to land for $62,000 and credits to notes payable for $50,000 and to cash for $12,000, related to the additional cost. We would say that Smart Touch Learning capitalized the cost of the land at $62,000. Capitalized means that an asset account was debited or increased because the company acquired an asset. So for our land example, Smart Touch Learning debited the land account for $62,000, the capitalized cost of the asset. Land and land improvements are two entirely separate assets. Recall that land is not depreciated. However, the cost of land improvements is depreciated over the asset's useful life. The cost of a building include, if you're constructing it, architectural fees, building permits, contractor charges, and payments for materials, labor, and miscellaneous costs. If you're purchasing an existing building, it would include the purchase price as well as any cost to renovate the building to ready the building for use, which may include any of the charges listed under the construction of a building. The cost of machinery and equipment includes the purchase price, transportation charges, insurance while in transit, sales tax and other taxes, purchase commission, installation, and testing cost. After the asset is up and running, the company no longer capitalizes the cost of insurance, taxes, ordinary repairs, and maintenance to the equipment account. From that point on, insurance, taxes, repairs, and maintenance costs are recorded as expenses. Furniture and fixtures includes desks, chairs, file cabinets, display racks, shelving, and so forth. The cost of furniture and fixtures includes the basic cost of each asset, less any discounts, plus all other costs to ready the asset for its intended use. For example, for a desk, this may include the cost to ship the desk to the business and the cost paid to a laborer to assemble the desk. A company may pay a single price for several assets as a group. This is called a lump sum purchase or a basket purchase. For example, Smart Touch Learning may pay a single price for land and a building. For accounting purposes, the company must identify the cost of each asset purchased. The total cost paid, 100%, is divided among the assets according to their relative market values. The relative market value method is a method of allocating the total cost 100% of multiple assets purchased at one time. Total cost is divided among the assets according to their relative market values. Suppose Smart Touch Learning paid a combined purchase price of $100,000 on August 1st, 2017 for the land and building. An appraisal indicates the land's market value is $30,000 and the building's market value is $90,000. How will the accountant allocate the $100,000 paid for both assets? First, calculate the ratio of each asset's market value to the total market value for both assets. The total appraised value is $120,000. The land represents 25% or $30,000 divided by $120,000 of the purchase, and the building represents 75%, $90,000 divided by $120,000 of the purchase. In our example, 25% of the cost should be allocated to the land. 25% of $100,000 is equal to $25,000, and 75% of the cost should be assigned to the building. 75% of $100,000 is $75,000. The journal entry will include a debit of $25,000 to land, a debit of $75,000 to building, and a credit of $100,000 to notes payable. Accountants divide spending on plant assets after the acquisition into two categories: capital expenditures and revenue expenditures. A capital expenditure is an expenditure that increases the capacity or efficiency of a plant asset or extends its useful life. A capital expenditure is also called a balance sheet expenditure because the cost of the expenditure is reported on the balance sheet as an asset. A capital expenditure is debited to an asset account because it increases the asset's capacity or efficiency or extends the asset's useful life. Examples of capital expenditures include the purchase price plus all the other costs to bring an asset to its intended use. An extraordinary repair is a capital expenditure because it extends the asset's capacity or useful life. Expenses incurred to maintain an asset in working order, such as repair or maintenance expense, are not debited to an asset account. Examples include the cost of maintaining equipment, such as repairing the air conditioner on a truck, changing the oil filter, and replacing its tires. These ordinary repairs are called revenue expenditures and are debited to repairs and maintenance expense. Revenue expenditures, often called income statement expenditures, do not increase the capacity or efficiency of an asset or extend its useful life, and are reported on the income statement as an expense in the period incurred. Spending $3,000 to rebuild the engine on a 5-year-old truck is an extraordinary repair because it extends the asset's life past the normal expected life. The $3,000 is capitalized by debiting truck and crediting cash. Smart Touch Learning paid $500 cash to replace tires on the truck. This expenditure does not extend the useful life of the truck or increase its efficiency. The $500 is expensed by debiting repairs and maintenance expense and crediting cash. Exhibit 9.3 shows A. Capital expenditures and B. Revenue expenditures for a delivery truck. Treating a capital expenditure as an expense or vice versa creates an accounting error. Suppose a business replaces the engine in a truck. This would be an extraordinary repair because it increases the truck's life. If the company expenses the cost by debiting repairs and maintenance expense rather than capitalizing it, debiting the asset, the company would be making an accounting error. This error has the following effects: overstates repairs and maintenance expense, understates net income, understates stockholders' equity, and understates the truck account or asset on the balance sheet. Incorrectly capitalizing an expense creates the opposite error. In the second section, we will learn how to account for depreciation using the straight line, units of production, and double declining balance methods. Depreciation is the allocation of a plant asset's cost to expense over its useful life. Depreciation matches the expense against the revenue generated from using the asset to measure net income. All assets except land wear out as they are used. In addition, physical factors like age and weather can cause depreciation of assets. Some assets, such as computers and software, may become obsolete before they wear out. An asset is considered obsolete when a newer asset can perform the job more efficiently than the old. Depreciation is not a process of valuation. Businesses do not record depreciation based on changes in the asset's market value. Depreciation does not mean that the business sets aside cash to replace an asset when it is used up. Depreciation has nothing to do with cash. To compute depreciation for a period, we need to consider three primary factors: estimated useful life, the capitalized cost of the asset, and the estimated residual value of the asset at the end of its estimated useful life. The useful life is the length of the service period expected from an asset. It may be expressed in time, such as months or years, or usage, such as units produced, hours used for machinery, or miles driven for a truck. The residual value is the expected value of a depreciable asset at the end of its useful life. When a company decides to dispose of an asset, the company sells or scraps it. The residual value is the amount the company expects to receive when it disposes of the asset. Residual value can sometimes be zero if a company does not expect to receive anything when disposing of an asset. If a company plans on trading in an asset for a new asset, the residual value will be the expected trade-in value. Estimated residual value is not depreciated because the company expects to receive this amount at the end. The depreciable cost is the cost of a plant asset minus its estimated residual value. There are three common depreciation methods: straight line depreciation, units of production depreciation, and double declining balance depreciation. As we work through each method, we will use the following information. Smart Touch Learning purchases a truck on January 1st, 2019. The truck has a cost of $41,000 and an estimated residual value of $1,000. The estimated useful life of the truck is 5 years or 100,000 miles. Under the straight line method, residual value is deducted from the depreciable cost and then divided by the estimated useful life of the asset. The straight line method is a depreciation method that allocates an equal amount of depreciation each period. Straight line depreciation is equal to cost minus residual value divided by useful life. In the Smart Touch Learning example, the depreciable cost is $40,000. Divided by an estimated useful life of 5 years, the annual depreciation for the truck is $8,000 per year. Depreciation expense is reported on the income statement. Accumulated depreciation is a contra asset account that is reported on the balance sheet. The book value is a depreciable asset's cost minus accumulated depreciation. The book value is reported on the balance sheet. A straight line depreciation schedule for the truck is shown in Exhibit 9.5. The final column on the right shows the asset's book value, which is cost less accumulated depreciation. Notice that the depreciation expense amount is the same every year, and the accumulated depreciation is the sum of all depreciation expense recorded to date for the depreciable asset. As an asset is used, accumulated depreciation increases and book value decreases. At the end of its useful life, the asset is said to be fully depreciated. An asset's final book value is its residual value. The units of production method allocates a varying amount of depreciation each year based on an asset's usage. Units of production depreciates by units rather than by years. A unit of output can be miles, units, hours, or output depending on which unit type best defines the asset's use. When a plant asset's usage varies every year, the units of production method does a better job of matching expenses with revenues. Continuing with the truck example, the truck is estimated to be driven 20,000 miles the first year, 30,000 the second, 25,000 the third, 15,000 the fourth, and 10,000 the fifth, for a total useful life of 100,000 miles. The first step is to compute the depreciation per unit of use. In this case, the asset is expected to have a useful life of 100,000 miles. The depreciable cost of the truck is $40,000. So the truck will be depreciated 40 cents per mile for every mile driven. In step 2, we compute the amount of depreciation for the current period based on the depreciation per unit of use and the actual use. In this case, 40 cents per mile for 20,000 miles results in depreciation in year 1 of $8,000. This is the same depreciation amount given by the straight line method is only a coincidence. Because the units of production method is so unpredictable, we have no idea how much depreciation will be in year 2. It might be as much as $32,000 if the truck is driven as much as 80,000 miles in year 2, or zero if the truck is not used at all in year 2. Units of production depreciation for the truck is illustrated in Exhibit 9.6. Accelerated depreciation is a method that expenses more of an asset's cost near the start of its useful life and less at the end of its useful life. The main accelerated method of depreciation is the double declining balance method. The double declining balance method is an accelerated depreciation method that computes annual depreciation by multiplying the depreciable asset's decreasing book value by a constant percentage that is 2 times the straight line depreciation rate. Note that residual value is not included in the formula. Residual value is ignored until the depreciation expense takes the book value below the residual value. When this occurs, the final year depreciation is calculated as the amount needed to bring the asset to its residual value. Exhibit 9.7 shows the double declining balance depreciation schedule. It reflects the calculations for year 1 and year 2 shown on the prior slide. Notice that after year 4, December 31st, 2022, the truck's book value is $5,314. By definition, the truck is to last 5 years, which ends on December 31st, 2023. At the end of the asset's life, its book value should equal the residual value. Therefore, in the final year, depreciation is book value $5,314 less the $1,000 residual value, or $4,314 in depreciation expense. Annual depreciation expense amounts vary, but total accumulated depreciation is $40,000 for all three methods. Deciding which method is best depends on the asset. A business should match an asset's expense against the revenue that the asset produces. Exhibit 9.8 shows the three methods in one graph for additional comparison. Notice that the straight line method produces a straight line on the graph because there is an equal amount of depreciation expense each year. The double declining balance method produces a line that is decreasing, and the units of production method's line varies based on usage. The Internal Revenue Service, or IRS, requires that companies use a specific depreciation method for tax purposes. This method is the Modified Accelerated Cost Recovery System called MACRS. Under MACRS, assets are divided into specific classes such as 3-year, 5-year, 7-year, and 39-year property. Businesses do not get to choose the useful life of the asset. Instead, the IRS specifies the useful life based on the specific classes. For example, office furniture has a 7-year life for tax purposes, but might only be depreciated for 5 years for book purposes. MACRS is not acceptable for financial reporting under GAAP. Partial year depreciation also applies to disposal of assets, which we will cover later in this chapter. If an asset is disposed of during the year, the business must calculate depreciation for only the time period the asset was in service before the asset was disposed, not the entire year. Returning to our example, assume that the truck was placed into service on July 1st, 2019. Therefore, the truck was in service for 6 months in 2019, from July 1st through December 31st. Because the business used the asset for 6 months of the year, we only record 6/12, 6 out of the 12 months of straight-line depreciation expense, or $4,000 in 2019. For example, the business may find that its truck lasts 8 years instead of 5. This is a change in estimated useful life. Accounting changes like this are common because useful life and residual value are estimates and, as a result, are not based on perfect foresight. When a company makes an accounting change, generally accepted accounting principles require the business to recalculate the depreciation for the asset in the year of change and in future years. They do not require that businesses restate prior year's financial statements for this change in estimate. Smart Touch Learning used the truck purchased on January 1st, 2019 for 2 full years. The truck cost $41,000, had a $1,000 residual value, and a 5-year life. Straight line depreciation for 2 years is equal to $41,000 minus $1,000 residual value divided by 5 years, or $8,000 per year, times 2 years is equal to $16,000. The remaining depreciable book value, cost less accumulated depreciation, is $25,000, $41,000 minus $16,000. Smart Touch Learning believes the truck will remain useful for 6 more years for a total of 8 years. Residual value is unchanged. At the start of 2021, the company would recompute depreciation. $25,000 divided by minus $1,000 divided by 6 years, which is equal to $4,000 per year. In years 2021 to 2026, the yearly depreciation entry based on the new useful life would debit depreciation expense truck and credit accumulated depreciation truck for $4,000. Plant assets are reported at book value on the balance sheet. Companies may choose to report plant assets as a single amount with a note to the financial statements that provides detailed information, or companies may provide detailed information on the face of the financial statement. The cost of the asset and the related accumulated depreciation should be disclosed. Exhibit 9.9 shows the 2 alternative reporting treatment for plant assets. In the third section, we will learn how to journalize entries for the disposal of plant assets. Eventually, an asset wears out or becomes obsolete. The business can discard the plant asset, sell the plant asset, or exchange the plant asset for another plant asset. Plant assets remain on the business's books until they are disposed of. If the asset is still useful, the company may continue using it even though no additional depreciation is recorded. If the asset is no longer useful, it is disposed of. This requires a business to remove the asset and associated accumulated depreciation from the books. In addition, a gain or loss might be recognized by the company. Regardless of the type of disposal, there are 4 steps. First, bring the depreciation up to date. 2. Remove the old disposed of asset and associated accumulated depreciation from the books. Third, record the value of any cash received or paid in the disposal of the asset. And 4, determine the amount of any gain or loss. Gain or loss is determined by comparing the cash received and the market value of any other asset received with the book value of the asset disposed of. Discarding plant assets involves disposing of the asset for no cash. Smart Touch Learning discards equipment that costs $10,000. The accumulated depreciation on the asset is $10,000. In other words, the asset is fully depreciated. There is no cash involved in this transaction. To dispose of the equipment, Smart Touch Learning will need to credit the asset account equipment and debit accumulated depreciation equipment. On July 1st, Smart Touch Learning discards equipment with a cost of $10,000 and accumulated depreciation of $10,000. After disposal, the equipment and accumulated depreciation equipment accounts have a zero balance. In the second example, Smart Touch Learning discards equipment that costs $10,000. Unlike in the previous example, the asset is not already fully depreciated. Because the asset sold in the middle of the year, we must compute and record a half year's depreciation before recording the asset's disposal. The asset already had $8,000 accumulated depreciation. There is no cash involved in this transaction. In this situation, there is a $1,500 loss due to the difference between the asset's book value, $1,500, and the market value received, 0. The account loss on disposal will be used. This account has a normal debit balance and is reported in the other income and expenses section of the income statement, which includes gains and losses on the sale of plant assets. On July 1st, the company sells equipment with a historical cost of $10,000 and accumulated depreciation as of December 31st of the previous year of $8,000. Annual depreciation is $1,000. The first step is to bring the depreciation up to date by debiting depreciation expense and crediting accumulated depreciation equipment for $500. Suppose that Smart Touch Learning sells the equipment for $1,500. When a business sells an asset for book value, no gain or loss is recorded. This is because the cash received is equal to the book value of the asset sold. The entry to record the sale contains no gain or loss because the asset was sold for book value. If Smart Touch Learning sells the equipment for $4,000, a company will record a gain on sale of the equipment. Notice that the cash received is more than the book value of the asset. When a business sells an asset for more than its book value, a gain is recorded. The account gain on disposal will be used. This account has a normal credit balance and is reported in the other income and expenses section of the income statement. In recording the journal entry, Smart Touch Learning will remove the old equipment and accumulated depreciation from the books. Step 2, record a debit to cash for $4,000. Step 3, and then record a credit to gain on disposal. Step 4. If Smart Touch Learning sells the equipment for $500, the company will record a loss on the sale of the equipment. Notice that the cash received is less than the book value of the asset. When a business sells an asset for less than its book value, a loss is recorded. In recording the journal entry, Smart Touch Learning will remove the old equipment and accumulated depreciation from the books. Step 2, record a debit to cash for $500. Step 3, and then record a debit to loss on disposal. Step 4. In each disposal illustrated, the company has decreased net income over the life of the asset by recording depreciation expense each year prior to the disposal. When the company records the disposal, the company will record a gain, a loss, or neither. Gains recorded at disposal increase net income, and losses recorded at disposal decrease net income. Over the life of the asset, the company records a net decrease in net income equal to the net cost of the asset. The net cost of the asset is the amount paid for the asset when it was purchased, less the cash received at disposal. Notice in each case that the net decrease in net income is equal to the net cost of the asset. We have, in effect, expensed the net cost of the asset over its life. Exhibit 910 summarizes the journal entries for discarding and selling of plant assets. In the fourth section, we will learn how to account for natural resources. A natural resource is an asset that comes from the earth and is consumed. Examples include iron ore, natural gas, diamonds, gold, coal, and timber. Natural resources are expensed through depletion. Depletion is the process by which businesses spread the allocation of a natural resource's cost to expense over its usage. It is called depletion because the company is depleting or using up a natural resource such that at some point in time there will be nothing left to extract. Depletion is computed by the units of production method. Assume an oil well costs $700,000 and is estimated to hold 70,000 barrels of oil. There is no residual value. If 3,000 barrels are extracted during the year, depletion is calculated as cost minus residual value divided by estimated total units. So 700,000 minus 0 divided by 70,000 barrels is equal to $10 per barrel. Then multiply the depletion per barrel by the number of barrels for the period, so $10 per barrel times 3,000 barrels is equal to $30,000 of depletion in year one. The depletion entry for the year debits depletion expense oil reserve and credits accumulated depletion oil reserves for $30,000. Accumulated depletion is a contra asset account similar to accumulated depreciation. Natural resources can be reported on the balance sheet as the net of the natural resource account and the accumulated depletion account. In this section, we will learn how to account for intangible assets. The final group of long-lived assets is intangible assets. An intangible asset is an asset with no physical form that is valuable because of the special rights it carries. Intangible assets convey special rights from patents, copyrights, trademarks, and other creative works. In our technology-driven economy, intangibles are very important. The intellectual property of a business is difficult to measure. Intangibles can account for most of a company's market value, so companies must value their intangibles just as they value other assets such as merchandise, inventory, and equipment. Intangible assets that are purchased are recorded at cost. If an intangible is not purchased, only some limited cost can be capitalized. Most purchased intangibles are expensed through amortization. Amortization is the process by which businesses spread the allocation of an intangible asset's cost over its useful life. Intangibles either have a definite life or an indefinite life. Intangibles with an indefinite life have factors such as legal and contractual obligations that limit the usage of the intangible asset. Only intangibles that have a definite life are amortized. Intangible assets that have with an indefinite life are tested for impairment annually. An impairment is a permanent decline in asset value. Impairment occurs when the fair value of an asset is less than the book value. In other words, there has been a permanent decline in the value of the asset. If an impairment occurs, the company records a loss in the period during which the decline is identified. A patent is an intangible asset that a federal government grant conveying an exclusive 20-year right to produce and sell a process, product, or formula. Suppose Smart Touch Learning pays $200,000 to acquire a patent on January 1. Amortization expense is calculated using the straight line method. Notice that Smart Touch Learning credited the amortization directly to the intangible asset patent instead of using an accumulated amortization account. A company may credit an intangible asset directly when recording amortization expense, or it may use the account accumulated amortization. Companies frequently choose to credit the asset account directly because the residual value is generally zero and there is no physical asset to dispose of at the end of its useful life. So the asset essentially removes itself from the books through the process of amortization. At the end of the first year, Smart Touch Learning will report this patent at $160,000. $200,000 cost minus first year amortization of $40,000. The next year at $120,000 and so forth. Each year for 5 years the value of the patent will be reduced until the end of its 5-year life, at which point its book value will be zero. A copyright is the exclusive right to reproduce and sell a book, a musical composition, a film, another work of art, or intellectual property. Copyrights also protect computer software programs such as Microsoft Windows. Issued by the federal government, a copyright is granted for the life of the creator plus 70 years. A trademark, also called a trade name, is an asset that represents distinctive identifications of product or services, such as the Nike swoosh or the McDonald's golden arches. The cost of a trademark or trade name is amortized over its useful life. Franchises are privileges granted by a business to sell goods or services under specified conditions. The Dallas Cowboys football organization is a franchise granted by the National Football League. McDonald's and Subway are well-known franchises. A license is a privilege granted by a government to use public property in performing services. A radio station might be granted permission by the federal government to use the airwaves to broadcast music. The acquisition cost of a franchise or license is amortized over its useful life. In accounting, goodwill is the excess of the cost of an acquired company over the sum of the market value of its net assets. That is, assets minus liabilities. Goodwill is the value paid above the net worth of the company's assets and liabilities. Goodwill is recorded only by an acquiring company when it purchases another company and pays more for that company than the market value of the net assets acquired. An outstanding reputation may create goodwill, but that company never records goodwill for its own business. According to GAAP, goodwill is not amortized. Instead, the acquiring company measures the fair value of its acquired goodwill each year. White paid $2 million above the market value of Mocha's net assets. Therefore, that $2 million is considered goodwill. White's entry to record the purchase of Mocha creates goodwill with a debit of $2 million. Exhibit 911 summarizes the type of assets and their related expense. Plant assets are those assets that have physical characteristics and are used in operations. Natural resources are assets that come from the earth and can be ultimately used up. Intangible assets are assets whose value is not derived from their physical substance. In the sixth section, we will use the asset turnover ratio to evaluate business performance. The asset turnover ratio measures how efficiently a business uses its average total assets to generate sales. Asset turnover ratio is equal to net sales divided by average total assets. Average total assets is equal to beginning of period total assets plus end of period total assets divided by 2. Using net sales revenue and total assets in millions from Kohl's Corporation's 2015 annual report, we can calculate the asset turnover ratio. Suppose that the asset turnover ratio for the industry is 1.9 times. Kohl's asset turnover ratio of 1.37 times is significantly lower than the industry average. This tells us that Kohl's is only producing $1.37 of net sales revenue for each dollar of assets invested, while the average company in this industry is producing $1.90 in net sales revenue for every dollar invested in assets. Kohl's should evaluate ways to improve its efficiency and increase its asset turnover ratio, such as increasing net sales revenue or decreasing average total assets. In the last section, we will learn how to journalize entries for the exchange of plant assets. Sometimes plant assets are not simply sold or purchased, but instead a plant asset is exchanged for another plant asset. An exchange has commercial substance if the future cash flows change as a result of the transaction. Commercial substance is a characteristic of a transaction that causes a change in future cash flows. In other words, an exchange has commercial substance if, in the future, cash flows, receipts of revenue, or payment of expenses of the business will change because of the exchange. For example, exchanging an older asset for a new asset will increase productivity, thereby creating more revenue for the business. On December 31st, Smart Touch Learning exchanges $2,000 of cash plus used equipment with a historical cost of $10,000 and accumulated depreciation of $9,000 for new equipment. The new equipment has a market value of $8,000. This exchange has commercial substance. There is a $5,000 gain on this transaction. The journal entry removes the old equipment and its accumulated depreciation, records the new equipment and payment of cash, and recognizes the gain on disposal. On December 31, Smart Touch Learning exchanges $2,500 cash plus used equipment with a historical cost of $10,000 and accumulated depreciation of $9,000 for new equipment. The new equipment has a market value of $3,000. The exchange has commercial substance. There is a loss of $500 on this transaction. The journal entry removes the old equipment and its accumulated depreciation, records the new equipment and payment of cash, and recognizes the loss on disposal. This is the conclusion of the presentation on Chapter 9.